Hey everyone, today is Thursday, June 11, 2020. Let's take a look at the market. Uh, Today I did not expect this to happen, like this very sharp retraction. We came down quite a bit in a day, about at the maximum almost 6%. And so we basically came down around 7% from the peak. And I gotta say, I did not expect the market to go down that much in a day at this point because at this level, I was expecting the market to hit 3,100. It went to 3,200, so obviously, even based on my own projection, that was way above my target, and it just shows that the market was overbought, and now we came down with this sharp decline and. What's gonna happen next? So as you guys know, I sold it here. I never caught this rally in my trading account, so that's why I've been very disconnected from the market for a while from the S&P 500 because I just couldn't find an entry point along this rally, right? And which is okay for me. And so now we get to this point. I think the what's going to happen is that I don't think this is the. I do not think that we're gonna start declining from this point on. I actually think that we're gonna bounce off this point and make a new high, which is way more likely. Today, the Fed people attribute this decline. If you read the news, you're gonna see that the news says that this decline is mostly due to the Fed announcement about the weakness of the U.S. economy, and also the investors' fear for a second wave in COVID-19. But I don't think that's the case. Let me just check here. Fed chairman. Let's check the news here. Okay, basically he came on Yahoo Finance, JPL, and he talked about there's not going to be a rate hike likely through 2022. It's kind of rare to see that this guy is speaking in a video format. Usually, the Fed announcement, usually they just announce it and in text format, in written format. So basically, he's saying that he doesn't really care about the asset price inflation. I'm talking about inflation asset price as a side effect of their interest rate policy, because their job is to maintain the proper functioning of the market, proper functioning of the economy, aka the labor market is more important what they're concerned. So the reason the labor market is such a great concern for the Fed is because they really want to target the unemployment rate, making sure the unemployment rate is low, right? Because the higher the unemployment rate, the more likely for social unrest. And the more social unrest, the more trouble the government is going to get. And plus, it's also bad for the safety of the general population, right? As you can see that because the recent incident, it triggers waves and waves of social unrest across the nation and across the world, and that's something that most government do not want to see. It doesn't matter whether you're on the left or you're a liberal or a conservative. It doesn't matter. You're Republican or Democrats. You don't want to have social unrest, right? But their ways of dealing with social unrest could be, maybe give these people more leniency, not leniency, more kind of support, government support, for example, like printing money and give them just checks, helicopter money, or they can send down the army and crack them down, right? That's also another way to suppress the social unrest. Look at North Korea. You don't see protests in North Korea because the government is able to send tanks down, right? There are two ways of suppressing the population, the general population, and the Fed, obviously in the United States, in the Western world, the government cannot really do the tank thing that often. They can send down the army, they can maintain the order, but they cannot do that all the time, right? They cannot just arrest anybody on the street and send them to a gulag. That's not gonna happen in the West right now. So what's gonna be is that they have to have a very loose monetary policy, and hopefully the business can get back online. The investment can go back on track, so there are more investment, more entrepreneurs going out there, create jobs. More jobs, that means more stable society. And if a Fed said that, if the side effect is, crazy housing market or crazy stock market, the Fed is not too concerned about asset bubbles at this point. They really want to making sure the labor market is back on track. And again, in the housing market in most part of the United States is actually not that crazy. Obviously, there are a few cities, a few states that are kind of crazy, like California, obviously. But most part of the United States, the housing market is kind of fair, right? So the Fed is not seeing a lot of risk in that sense. But the Fed is okay with a stock market bubble. That's something that most people don't understand. Why Fed is okay with stock market bubble? Well, the reason is the Federal Reserve. If you look at the past stock market bubble, there's actually a very concrete data showing that the stock market bubble, when the stock market bubble actually pops, it actually doesn't really hurt the general economy. I'm talking about the real economy, the labor market, that much. For example, the dot-com bubble burst, and during that time, after the dot-com bubble burst, the real estate market was actually good during the recession in 2000. And also the labor market barely was affected. So the Fed is actually okay with having bubble in these in virtual assets, right? Not in someone's houses. If the housing market bubble burst in 2008, it has a real impact on a lot of people because they just lose their homes and they couldn't find a place to live. But when the stock market bubble bursts, it's mostly just rich people losing money, right? So that's why the Fed is okay with stock market bubble, because the consequence of the stock market bubble is not as severe as the other types of bubbles. And the others, if they don't want the stock market bubble, they can choose to have more strict monetary policy, but the result would be lingering unemployment, and the economy might not get back up on its feet for longer, and that's not something that any government want to see. So right now, the Fed has no choice but to print money, to making sure the credit can keep flowing, and the investors can have a lot of money so they can invest into businesses, into entrepreneurs, so that the economy so the job creation process can keep ongoing. Okay, so but you're probably wondering, what is the downside of all these, right? The downside of all these would be it would be a impact on the major reserve currency in terms of store of value, right? If all the reserve currencies right now, like the euro, the U.S. dollar, Japanese yen, these are the three major currency in the world. They keep devaluing their currency, or there's a huge expectation that they're gonna keep devaluing their currency relative to the financial assets. Then these currency could eventually become challenged by some incumbents, like some of the rising powers, like the Chinese yuan, or maybe even a combination of cryptocurrency, right? That could be challenging the existing paradigm. That's what I'm trying to say. Okay, so what I'm expecting from this, so I am planning to buy something. I'm planning to buy into this market. Maybe tomorrow, the day after tomorrow, I want to see this thing just to maybe consolidate a little bit for 12 hours, 24 hours, and hopefully do a shakeout somewhere. I don't expect the shakeout to be so much bigger, but I think this level anything under 3,000 is a very good buy point, and I expect the market to fastly recover to a new high from this point. I think this is just a quick shakeout to a lot of buyers, to a lot of holders in the market to shake out the weak hands. I think we're gonna make a new high in the S&P 500 very soon. So, and this new high could come in very, very quick because the drop is very quick. I expect the rally could be very quick as well. Okay, and take a look at the cryptocurrency market. Obviously, the cryptocurrency market is being affected. Oh yeah, so this is a chart I did yesterday about Nasdaq. I talked about, you know, the trend is getting more and more vertical. It could be unsustainable, and indeed it was kind of unsustainable. But Nasdaq today also outperformed almost everyone else. You can see this dip is much smaller than the S&P 500 and Dow Jones. Okay, so we did have a correction through space, by the way. If you watched my yesterday's video about correction through space and corrections through time, you can see that today we had a huge correction through space, which means the market is likely to bounce off very quickly as well, right? That's just my logical conclusion here. That's what I expect. Okay, let's take a look at the Bitcoin market today. You know, yesterday I was talking about Bitcoin could be correcting through time, but you know, due to this external shock in the stock market, the Bitcoin also dropped. But you know, all the cryptocurrency today actually been holding up pretty well compared to relative to its volatility, general volatility, right? If you look at the Bitcoin, it only dropped very little compared to its overall volatility. And like, if you didn't tell me the stock market kind of corrected quite a bit today, I always thought this is just a like normal correction in Bitcoin, like a normal volatility events in Bitcoin and all the other cryptocurrency. So it's been holding up very well, actually. I'm really surprised. So yeah, so that's my. So I think Bitcoin could be, you know, drop even further to this level, and this level is absolutely a buy point in my opinion. So if it drops to this level, we should add to our Bitcoin position for much further upside, I think. And yeah, and that's everything. Hope you guys enjoy your night, and see you next time.